Well, good afternoon, investors. Welcome to our January 16th frigid edition of Bull Sessions. My name is Mark Robertson. I'm joined here by my dear friend and colleague, Ken Kavula. Good afternoon, Ken.
Good afternoon, Mark. It is cold outside. We finally got around, and I'm not helping, but we finally got around to taking our tree down. I'm watching my wife take ornaments off of our tree.
Uh-oh, we better talk fast so you can get back to helping her.
Well, I'm hoping we can lengthen this thing out so that she'll finish before I have to do anything. We'll see. She says that sounds right. So
that kind of thinking usually gets me into trouble in some way. So
likewise.
All right, well, welcome everybody. And yeah, it's rough. I mean, we talk about the weather here a lot, but when it gets down into negative numbers and you start talking negative 20, negative 30 wind chills, it definitely gets your attention if you have to go outside for any reason. So tough stuff. So let's turn to the pot-bellied stove and talk about a little bit of investing. And what we'd like to do here today is this will be probably an abbreviated session. I don't know, Ken. It'll be interesting to see when we get to the end of the program how it proceeds. But we are going to work on the Buttonwood portfolio a little bit. And of course, that's named in honor of the tree on Wall Street, where the original market participants would gather back, I believe, in the 1790s. Do I have that right?
I think it happened even before the revolution, Mark, that they were gathering there.
Well, we're going to we have to become experts on
this. We'll have to do some historical research, but I think it was actually before the revolution that was a gathering spot to trade stocks back and forth, or shares of companies back and forth.
Well, we'll get a little more up to speed on our history, but take care of that. And then we're just going to look at a few other things. Did want to share some quick screening results. We did find that those companies displayed on the right-hand side did end up near the top of screening results. Ken is still holding up the forbidden sign on most China or Taiwan considerations. So we'll see if we can't talk him down from the ledge at some point in the future, but that's not going to happen today. And just as you predicted, Ken, Humana did come out with some turbulent results. So that probably needs some time to sort itself out also. The insurance, the realm of insurance is really kind of a mess right now. So we will take a closer look at that one also, but let's go ahead and get underway. All right, here is our weekly reminder that Portillo's is not a sponsor of this session, but they should be. And today I did just add a little bit of 12 things I didn't know about Portillo's, and then I tried to look at the article and it wanted me to subscribe, so there are still 12 things I don't know about Portillo's because I didn't feel like subscribing to I don't even remember, some Central Illinois newspaper. But,
well, Mark, you'll be happy to know that we can celebrate the anniversary of the trading under the Buttonwood on May 17th.
Oh, let me jot that date down.
And that's the day before my wife's birthday, and the official anniversary is 1792.
Oh, that would have been my guess.
But there are rumors that it began 20 or 25 years prior, but the first actual records date back to May 17th, 1792.
Yeah, probably for the 20 years before that, adult beverages got in the way of keeping any records or something to that effect.
And the address was 68 Wall Street.
68.
That's where the Buttonwood tree was.
Okay, the things we now know. And then McDonald's came out with an announcement fairly recently that they're going to bring back the double Big Macs. So just thought everybody would appreciate knowing that out there. All right, here's our standard disclaimer. Everything we do here is about education, demonstration, and illustration. No investment recommendation is intended. It is literally an effort to share the lessons, pretty powerful lessons learned in nearly 8 decades of the modern investment club movement. We will be talking about how we discover stocks, how we analyze them, and how we build and maintain portfolios. But please do your own homework before you make any type of a decision about any of this stuff. And again, just be prudent and be your own steward. All right, the roundtable is what, a couple weeks out, Ken, till we get together again?
Yeah, it's going to be on the 30th this year, or this month, the 30th of January. So
So
we're
we're
2 weeks
2 weeks.
out. Uh-huh.
Okay. And that's our monthly gathering, similar situation, although we specifically call out 4 or 5 individual companies and walk through the analysis of them just in an effort to share ideas and techniques. So that is called the roundtable. Again, webcast. You can come in your pajamas with your favorite beverage and attend. If you'd like to receive a reminder about that particular monthly event, it's free. Send an email to ncavula1@comcast.net, and she'll be happy to walk you through what needs to be done to make sure you get those reminders. If you have any follow-up questions or suggestions for us, our 2 email addresses are down there at the bottom of the page. markr@manifestinvesting.com, kcavula1@comcast.net, and that's all we got for now. All right, so Ken, moving on to our slide, which I keep thinking I'm not going to show this every week, but I think it's a pretty good launch pad, and you'll see why in the following slide. But we're kind of back at fairly normal conditions. The median return forecast that you see over here on the right-hand side, my par is at 10. I don't know if you caught this, Ken, but the projected return on value, the average or median value for that lines up right at 10. So they both have actually
That's
found
great.
each
Yeah.
other. So we noticed that happened last week and continues today. So that's basically just saying we're pretty close to fairly normal conditions for the average stock study. Value Line backs that up with their own version at a 10%-ish number. And anything else you'd like to add to that, sir?
Well, I just think it's showing us why it's much more difficult today than it was maybe 6 months ago to find good stocks that are reasonably priced. You have to work a little bit harder right now to find stocks in the buy zone. You have to work a little bit harder to find stocks with a decent appreciation potential. And that's just because you're in an average market, and during an average market, you need to work.
Okay, so let's go ahead and the reason I'll just move to the next slide is we did get a question from one of our regular attendees, and it's a good question. And sometimes the most innocent question can lead to an interesting discussion. So here you go. David Turner asked, what is the line of reasonable expectations that we show on this darn chart every week? And how is it calculated? And so I just thought I would share what the inspiration behind it was. And it comes right back to the book by the longtime chairman of the American Association of Individual Investors, James B. Clunan. And a little while back, we had a fairly extensive discussion. I don't remember if we did this during bull sessions or not, Ken, but
We did, Mark. We
we
did
did.
pieces of
Okay.
it. Yeah.
We did pieces. So you can actually go back to that link on the lower left if you're a Manifest Investing subscriber and take a look at some of the discussions that went on. The synopsis that we came up with at the time just simply said that a lot of the things that he thinks, he being Jim Clunan, uh, aligned very closely with George Nicholson, was our conclusion. And it's kind of fun to go back and see um, just 2 different ways of looking at the same challenge. And as you can see here, I mean, I use the phrase evidence mapping because this literally is you're looking at evidence, literally the stock prices in the Value Line Investment Survey represented by the green bars on this chart. And then the blue line is just simply what it says. It's just a mathematical regression through that. Ken, is there a way that you would explain that for maybe a person that's a
Well,
little bit averse to math?
explain a couple different things. First of all, that blue line's just the average return over, what is this graph, go all the way back to 99. So average return over about 25 years in the stock market. And it's a consistent number. and it's not straight like we're used to seeing on a stock selection guide, because we're not graphing it on that special kind of graph paper. We're graphing this on a regular system, the kind that you learned about in 5th and 6th grade. Notice the horizontal lines are all spaced evenly with each other, and consistent growth on a normal graph, a Cartesian graph, for those of you that understand the lingo, a consistent growth on a Cartesian graph, graphs in this shape, and the shape has a name. It's called a parabola. So it's just a line. It's akin, if we were to graph these bars on that same kind of graph paper that we graph using the stock selection guide, then that blue line would be straight, and the slope would be measured at about 11.1%.
Yeah, and the other thing that I found that is kind of reinforcing, I mean, we basically take a look at that 10 or 11% forecast for the average study and say that's a fairly normal condition. Well, that would be if the green bars were basically right on the blue line. Clunan actually spends some time talking about the white space that you see in places like over here in the middle, and even the stuff that we saw, right over the last couple of years down here. Anytime that there's white space below the blue line, he basically described that as potential opportunity. And basically get in there and start looking for opportunities. And just the opposite when you have situations like this. And in fact, he went into a fairly specific discussion of anytime you see that and you are a person that is actually making withdrawals against that in order to stay alive, usually an experienced person farther down the time horizon, you want to behave differently. But for everybody else, it doesn't matter. And he actually went into a fairly detailed explanation of why he felt that way.
Yeah,
So,
I hope most of you can see the inverse relationship between appreciation, whether it's the red dots or the gold dots, but there's an inverse relationship between those dots and where the green bars are. The further below the blue line that the green bars go, the higher up are the red dots and the gold dots. In simple English, that just means that appreciation gets higher when the stock market is in the doldrums. That makes common sense. We've known forever that when things are bad, that's a real great opportunity to find lots and lots of companies selling at really good prices. And then obviously the reverse is true. When those green bars go above the blue line, you can see that the returns begin to move down the graph. They're much lower than average, than you might anticipate. We're right around average right now at 10, 11%. So those dots are right around average, and the bars are right around the blue line, right, close to right on the blue line. So it's a very interesting graph, and it can become extremely sophisticated the more you think about it.
I'll never forget being confronted by a regulatory authority. And you probably might even remember this, Ken, because we were sitting around having adult beverages one night, and the person basically challenged this notion of, could you actually say when it is time to back up the truck? And we had a fairly extensive discussion about it, but this was basically it. And you can go back and look at our writings back in that time frame, and you'll find that we actually had two back up the truck commentaries. The first was in November of 2008. We were a little early. And then the second was at the end of February 2009. And we got that one really right. That's when the stock market took off and then advanced back to the blue line. So it really is driven by, I would almost dare to say, a little bit of science. So
Yeah, well,
cool stuff.
the Clunin block is hiding the scale for the dots, but the dots are measured in percentages, and you can see the bottom of the scale where it says 0%, but the box is hiding the rest of the scale. We have enough history for MyPar now. There you go. We have enough history for MyPar now to understand when MyPar is a little bit overvalued, and I start to kind of get really excited when my par moves around above 13, 14%. I think that's the kind of a trigger for me that it's maybe time to start considering backing up the truck. When it moves to 16 or 18%, that's definitely the time to back up. And it's been there a couple of different times in my investing history. This 99 through 2023 is a little bit shorter than my actual investing history. Value line medium appreciation has mimicked my par pretty nicely, although it tends to be a little bit higher than my par on a fairly regular basis. But I think that in bad times, it really spikes up there. What do you attribute that to, Mark, that the difference between the gold dot and the red dot spikes up so much between them in 2008 and again at the height of the pandemic? You think it's just
It,
value line being extremely aggressive?
yeah, I think you'd find similar behavior if you charted an analyst consensus type. Maybe I'll try that sometime.
Yeah,
A long list of things to maybe do. Yeah, it really revolves around the reality that their pessimism and their optimism are among the most reliable things on the planet.
yeah.
And
That
sometimes that,
pendulum back and forth, right?
yeah, so it really is the swinging that we try to take advantage of. And I think that's behind a lot of what you see there. Anyhow, enough on this subject, but I thought it was a good question, and we're pleased to hear it. So thank you, Mr. Turner. All right, an update on the Groundhog Challenge. It continues to be an Ardelyx fueled phenomenon. We left the ones color coded in orange that are up there. Ken is among the few, the proud, that have a portfolio that's up near the top without Ardelyx in it.
I'm
But
going to have to get a hold of Ginger and Bonnie here, and the three of us are going to have to hold hands to just keep our head above water with all these Ardelyx people here. Yeah,
a little kumbaya. And of course,
yeah.
Kim is up near the top, and she's been an Ardelyx advocate and very close stock watcher for the last few years. She apparently still having difficulty with her audio.
Oh no, I'm just enjoying you two talk. I
Oh,
can
okay.
add that I am still enjoying watching Ardelyx.
Yeah, last
I
I
can
checked.
just
Go
I
ahead,
can
Ken.
just make the same comment that I made last week, Mark, that I'll take 34% return any day, and more power to the rest of you, okay?
Yeah, and again, we've pointed this out before, but with real money, Ken went from $2 to $6 in Ardelyx a few years ago. So it's not like he's like the thing we aspire to become. Um,
You mean
I,
having the discipline to get out of it?
well, yeah, I can remember specifically when you decided to exit after
Yep,
a 200% gain because you basically just said that the government was kind of getting in the way, and
yep.
that's really sugarcoating it. But that was your sidestep, and I suspect that you don't regret it for a minute.
Not at all. Not at all.
So anyhow, some good stuff here. I would point out that you can't see it on the slide, but from 41 to 48 are all investment clubs or group entries. So they're just barely off the chart. All right. I think that's all we need to say about that for now. I thought this was a cool chart.
Cheryl wants to know, Mark, are you going to ban Ardelyx from the 2024 groundhog? Okay.
No,
Just tell
Yet
people
to
they
be
can't
yet to
pick
be
it.
determined.
All
yet to be
right.
determined. It could
Okay.
get banned. It could drop below the price limit and ban itself. You never know. Here, I'm
Mark,
Or
while
to get,
we're
or to
knocking on
get
wood.
bought out and then we're having cash in our accounts.
while
Yeah.
we're looking, Mark, could you go back one slide? David has a question about the arithmetic next to the 12% mark. Maybe you have to go back one more slide to erase that Clunan box.
Okay.
This is nothing more, David, than how you turn value lines 45% appreciation, how you annualize it. and this is read as 145% or 1.45, and this is the fourth, I'm sorry, this is the 1/4 power. That would be the, not the square root, that would be half power, not the cube root, that'd be a third power, but this is the quarter power, and then you subtract 1 to bring it down to take the 100% off, and you get 9.7. So if you were to take a dollar and raise it by 9.7% for 4 years, you would find out that that dollar had turned into $1.45.
Right.
That's about as clear as I can make it. And if the quarter power doesn't make any sense to you, then I don't have the time to try to make that work. Okay.
Yeah, it's 4 is the number of years n because that is the average value line forecast. Their 3 to 5 year forecast is basically a 4-year forecast, plus or minus a year. So that's why the 4 is there. So you can also
Uh,
raise it on your calculator to the 0.25 power and subtract 1.
right. David is saying he understands. Okay.
Okay.
Great.
All right. So pressing on, and those numbers are all going up at very nice trajectories at this point. Still see a very special difference here that virtually unprecedented. I might take a closer look at that also. Pretty tough. All right. This was an interesting graph that showed up from our friends over at Quarter, and I just thought it showed a really nice layout of many of the companies that we took a look at back in the middle of the summer as we built out that electrifying portfolio. I was also interested in the fact that Cisco is showing up down here because they were in the news just last week, along with a little bit of Fortinet and just some interesting companies to look at. There's a couple on here, Ken, that we did not include. Maybe we should run them up the flagpole also. I don't know if Legrand has an ADR or not, but they're all over this chart.
Mark, I'm going to suggest that we also I've been listening on television, and I've heard a number of different analysts now mention the fact that the building of data centers is going to be one of the most profitable things that can happen in the next 10 years.
Mm-hmm.
That we're going to be having data centers all over the place. They're going to be extremely dependent on the infrastructure of the state where they can be built. A company just wanted to put a data center in Northern Virginia, and were told that the grid could not support the amount of electricity that the data center was going to need.
Mm-hmm.
So these data centers are going to be moving to places where the grid is going to be able to handle the power demands, and there's actually a REIT with a pure play building of just data centers, owning just data centers. You can Google and look it up, but the company that was interesting to me was Iron Mountain. Do you remember the old Iron Mountain and what it used to do, Mark?
Yeah, that was document destruction and
And it still is about 80% document destruction, but they are moving big time into ownership of data centers. So if you're interested in this idea that that's going to be a very profitable business in the future, I'm just giving people the idea that Iron Mountain, which has a terrible looking stock selection guide, Iron Mountain is a company that is aggressively moving into this field of building and maintaining data centers.
well, sometimes a transformation can be very
Profitable.
opportunistic and
Yeah, rewarding. Yeah.
good stuff. All right, so there's some interesting names on there, and we'll throw Iron Mountain on the fire also. We looked at this last week. We're not going to spend a whole lot of time on it, but these are the companies that we did select. We did remark last week that some of these are really the nuts and bolts type companies, of this type of stuff. So sometimes the nuts and bolts can be quite rewarding, and I wouldn't be afraid to shop around even at the bottom end of that list a little bit for opportunity. All right. Here's one. Kim, did you send this to me?
No.
Not
Oh,
this one?
yes, I did.
You
Yes,
did.
I did.
You send me so many things you can't even remember. Anyhow,
Yeah, I remember this one because it's Detroit.
yeah.
And there was a certain football game I was watching I was excited about because I was born in Detroit.
All right. Well, this
Mark,
one,
we have a hand in the air. Carol's hand is in the air, and I'm going to
go ahead.
unmute her and see if she has a comment or a question. Carol, you're self-muted, so you'll have to unmute yourself in order to speak. There we go. Welcome, Carol. What can we do for
Carol.
you? We're not hearing anything, so I'm going to assume we're having a microphone issue, and I'm going to put Carol back on mute. She did put in the questions comments that Northern Virginia, not only are they having problems with the grid, but they're having problems with the population in Northern Virginia actively fighting the concept of these data centers being built in that area, especially near places that are really populated and places that have a great historical interest. So
Interesting.
Carol says that's going to be a NIMBY kind of a thing. NIMBY, not in my backyard, that kind of a thing. But the basic reason that they were denied the ability is that they couldn't get enough power to power the data center.
Yeah, the electrical grid infrastructure, it's been in the news again here over the last few days. I mean, there are places that desperately need power or transmission capacity, and there are places where it would make a whole lot of sense to install windmills, for example, and they can't because of the limitations of the local transmission system. So wild stuff. All right, so this one you can put in your confuse your friends with facts category here. I would never believe this until that's actually represented. Then I did a little bit of fact checking, and we had some stuff going on in our back office. But this one's crazy. At least for 1 month out of the sample, it's true. Good stuff. And that helps with our housing values. So we're all in favor of that. All right, Ken, this is one we've spent a little bit of time talking about. Ben Carlson shares these type of visuals all the time, and this is just another reminder that even though we had a good year last year, that does not necessarily portend that the coin's going to flip the other way and be negative. No one knows what's going to happen, but this is just simply a track record showing that a second or a third or a fourth year are certainly feasible. What are your
Or
thoughts?
even a fifth, like up in the 90s, up there in the upper right-hand corner of the chart.
Yeah, but Ken, there's a problem with that.
Okay.
You see the lost decade?
I do.
Well, you don't.
1999 all the way to 2009. 10 years in there where they didn't reach any double digits. The S&P was essentially flat. During that time period, we did a lot of work on where a typical better investing portfolio, a typical portfolio that had all of the above investing, small companies, medium companies, and large companies, handily beat the S&P without too much trouble. We know 2022 was a down year. 2023 was a double-digit year. So maybe 2023 is the start of a 3 or even 4 or even 5-year cluster. We won't look out much past that, okay?
Can't rule it out. And then all these people that have been talking about the Magnificent Seven, again, we've talked about it ad nauseum here, but the Magnificent Seven are barely back where they were 2 years ago. And there are very few people that recognize that. I mean, the average return on many of those stocks is, 2 or 3%
And
annualized
so
over those
much of
years.
it has to do, Mark, with the fact that we look at 3-month graphs and 6-month graphs and 1-year graphs. We don't bother to look at graphs that are longer term than that. And as really good, solid sleep at night investors, we should be looking at the history. We should be looking back 2, 3, 4, 5 years to make sure that we're not making assumptions about the company that don't have any basis in historical fact.
Absolutely. All right. One last article. This one is a good one from just a few days ago, day before yesterday, in fact. Maybe it was Friday. Anyhow, we see this a lot in markets like we are faced with today, this type of article. And the Wall Street Journal is just basically out seconding the motions made by the major banks, including Goldman Sachs, that it makes sense to get out there and hunt down quality. I don't know about you, Ken, but my reaction to this is, what's different about now? It's not, it's like some of these people mentioned in the article believe that there are cycles in quality, and I'm not sure I believe that. And Jeremy Grantham, who's mentioned up here at the top, we talked about him just a few weeks ago. They actually started an ETF. The ticker symbol is QLTY, and we will be watching that carefully. We tried to buy their quality-based small cap fund. More on that in a few minutes, but it is interesting, and there's some pretty good meat here. We'll talk about Jensen in a minute, but how did it strike you?
Well, I think, Mr. Bond, that last paragraph could be summarized in just 4 words: up, straight, and parallel. That's exactly what he's saying. I mean, he's, more importantly for us, we're looking for growth that is predictable. And we've been shouting that from the rooftops for as long as I've been associated with this style of investing. It's nothing new. It seems to work during almost any kind of market, whether it's an up market or a down market, and it seems to keep me relatively safe and allows me to sleep at night. I'm not so sure that any of this stuff is cyclical or that any of this stuff is brand new.
Yeah, so I kind of reached the same conclusion. Cliff Asness is a really smart guy, and there's some good research out there. Matt shared a couple links to this stuff, and we'll make sure it's in the show notes. But just found it kind of interesting. Drilling a little bit deeper into the subject, Jensen was mentioned. We have long held out the Jensen Fund. In fact, my wife has had the Jensen Fund in her IRA for probably the better part of 30 years. And one of the reasons it is an oasis and fairly safe is because of their emphasis on quality. That's the guy mentioning right here. The stuff that they're looking for, it's talked about up here also. That is our definition of quality, by the way. And it's pretty hard to argue with this one. I found it interesting that this was the 3rd fund that we added to Manifest Investing a long time ago, number 3. And from top to bottom on that list, it's pretty hard to argue against virtually any of them. It's a good list of quality companies.
Yeah, high quality doesn't always mean high potential return, but when the two of them overlap with each other, like they do, a half dozen times on this list, then you're looking at something that you really want to take some time with and you really want to study hard. I like your arrow pointing to Google. I think that it's very near a buy, if not a buy right now, and with a quality of 98, I think it's extremely attractive.
And it is a subject we could dig into a little bit deeper. A lot of times these companies like Pepsi or Hershey's, not on this list, but they come to mind. They don't get much higher than this very often. So sometimes you maybe just settle for a little bit less return forecast to take a position in some of these types of companies. But I agree, Ken, Starbucks is an interesting look. Might be some reasons to avoid it, but UPS has been kind of beat up a little bit on economic concerns. Nike has been, they had some fairly lackluster results. But if you're looking at it as a long-term investor, maybe that becomes an opportunity. But yeah, we're going to take and actually dive in a little bit more into Google as our potential first selection for the Buttonwood, at least the
Okay,
first
one of
stop.
our One of our investment clubs, Mark, dealt with this issue of a high quality company that doesn't always have a par that warrants a buy zone, and well, the company is Costco. And
Okay.
we had the opportunity about 8 months ago to buy Costco, and we had a very small amount of money. And the point was made that if we don't buy enough of the stock on the rare opportunity when we think it's a buy, then it's going to represent such a small piece of our portfolio that it will be just meaningless to what we're doing.
Mm.
So we actually sold something that had a lot, and I mean a lot less potential return attached to it, and took that money and bought a large enough stake in Costco that it was going to represent close to an average size holding. It's rewarded us tenfold since we bought it. It hasn't gone up 10 times, but the reward is so great. Costco just spun off a $150 a share special dividend to anybody holding it. And when the club sees a $3,000 income from a single stock coming from a special dividend, those 200 shares certainly kind of shine. You know, you're really excited about the good decision that you made.
Yeah, I want to point out that Costco special dividend probably during the next roundtable and perhaps at a future bull session because it's pretty significant, and
Yep.
just waiting for that opportunity. So let's go ahead and switch gears and turn to this demonstration portfolio that we have talked about doing. Again, we're talking about building out a portfolio using real money. It's a nominal amount of money, but what we want to do is demonstrate that you can, with a fairly modest amount of money, compile a well-diversified portfolio which aligns with many of our design characteristics. So, anything you'd like to add at this point, Ken, or should we just roll?
Well, you know my background in education, Mark, and when you're writing curriculum, when you're writing things, you hardly ever have an objective without a goal before the objective. And I'd like to propose a goal to this list, and the goal basically is to demonstrate to somebody with a relatively small bankroll that you can create a portfolio that mimics the largest portfolios that we look at, and you can be very successful investing very small amounts of money on a regular basis. Now, that's a pretty lengthy goal the way I stated it,
Mm-hmm.
but I think that's the goal of this particular portfolio, isn't it? To
Sure.
demonstrate that somebody with small amounts of money can be an investor.
Yeah, because again, starting early and then extrapolating this,
Yep.
as Ken and I are going to talk about, we ran into things that we did not necessarily expect. We're a few years removed from that time when I had to put the steaks back in the freezer and cook hot dogs that night. We're a little bit removed from that, so there are things that I've forgotten. I had forgotten about how much we did with dividend reinvesting programs and the mail back in the 1990s, Ken, to keep our costs down and investing in companies like RPM and all that. Well, we did that because if you went to Schwab, I believe at the time Schwab was $49 for a transaction in and out.
And Mark Schwab had the reputation at that point of being a low cost broker.
I know it.
We
Wow.
used Merrill Lynch during the 90s, during the mid 90s. And Merrill Lynch, we were paying upwards of $120, $130 a trade. And that was not only to make a buy, but it was also to make a sell. And then you had to run all around the city getting signatures on the stock certificates that you were holding. We were actually holding stock certificates in the mid 90s for many of the stocks that we owned. And you had to get the signatures authorized in various ways before the broker would even look at you and deign to sell them for you and give you some cash.
Ah, yes, the medallion signatures.
You got it.
Interesting. So a lot of that stuff has changed. I mean, that one had a lot to do with the investment clubs of the 1950s, 60s, and 70s, even up until in the 90s. That it was a cost-driven issue. So that one has changed fairly dramatically, but there still are some issues, and we'll talk about it here. Here's a look at the portfolio. Last week we did take the first uh, roughly 50%, 46.6%, and we're going to invest it in the Vanguard Growth Fund. And that's just simply to achieve an enticing amount of diversification. Plus, as Ken pointed out last week, you're invested in the Magnificent Seven in a big way with just simply that investment in VUG. So we're there. But there it turned ugly, Ken. I couldn't find anybody that would actually do the transaction on GMO small cap quality. The fund is fascinating to look at as far as the internal, so it'll be a source of ideas for us, but I couldn't find anybody that would do the transaction. And it was pretty wild. I did not expect
Well,
that.
I did not expect to be talking to brokerage firms since the last time we met, but I've talked to three or four at length, three or four different brokerage firms trying to set up the concept that we talked about at the last bull session. And surprisingly, it's much, much more difficult. And there are so many rules attached to what you can and can't do that I became a little bit discouraged by the whole concept of trying to do this with real money in real time.
Yeah, and I was basically wondering if there was an alternative to Robinhood. I do have an account at Robinhood, and it actually is quite functional and easy to use, but I didn't necessarily want to start another one. And then we found out that these firms have these programs called slices where you can invest in smaller amounts, but it's all, uh, uh, they basically have a rougher time with fractional shares, is what it boiled down to. And I tried to order 2.6 shares of something at E-Trade and found out that I couldn't do that. So that was a stunner for me. So that's kind of the situation. We will probably end up with an account at Robinhood, and it is extremely functional and easy to use. But I was hoping that it might make sense at either Fidelity or Schwab or something else. So we'll continue scratching our heads
But
a little bit, but we
but
want to
while
keep
we're
it
going
simple.
to add $100 a month, we're going to define an average holding as somewhere around 150 based on the math that's on the screen right there.
Yeah, so we'll try to build it out. We aren't going to necessarily do this every week, but as companies come to the forefront, we do want to build this out to 16, well, 12 to 20, but 16 companies on average, and basically aligning with those design characteristics on the first page there. So let's go ahead and get started, Ken. Here was just a quick look. Since we want 75% of the portfolio to be these what we refer to as core companies, I just asked the question fairly simply: what are the top core scores at Manifest Investing? And you guys will all remember, because there's a lot of familiar names in the audience, that it's just simply these three characteristics added together to reach this last number over here. And so there's very few surprises on there. A couple of these on the updates that just happened actually got dinged pretty good. So the list is pretty stable, but they do float around a bit. Anything jump off the page at you, Ken?
Well, I'm surprised to see that sales growth for Lululemon at such a number. That 19% surprises me a lot from a retailer in today's world. Uh,
It's hanging up there. It's definitely in the 15 to 20 range.
And then I very rarely look at a list like this where I can't identify what the company does. But can you help me out with Hamilton Lane? What exactly is that company? What do they do?
That's an emerging money manager / brokerage firm, and this number probably dips down when we take a look at some of the acquisition track record. So that one actually gets dinged a little bit on an update. But it's a very respected and up and coming money manager.
Yeah,
And,
I'm pretty familiar with the rest of the list here.
yeah, we talk about Costco
So
a lot, but I would like just to tip my hat in your general direction because right now, SEI Investments is the longest standing contribution to the roundtable tracking portfolio. And Ken, you did that back in 2010,
yeah,
and
I
it's
know,
still
but
there.
I got poo-pooed for picking up something that people didn't understand at the time. So uh, I, I got a lot of
Oh,
negative
yeah,
press for that one. So
Well,
yeah,
let
but you
them
got
eat.
to remember, Ken, if people don't understand or know about the stock, that means you may have found a diamond in the rough. Hats
well,
off to you.
I really like SEIC. I still like it. I don't think it's a buy today, but I
No,
still
probably
like
not. But it shows up on the quality list, and I will tell you, it was one of Ken Janke's favorite companies, Ken.
it. Yeah.
So, all right, another way of looking at the kind of the same information, but this time within a focus, because this does not tell you anything about the attractiveness from a price standpoint. This one does. It has the projected annual return on it and the projected return on enterprise value down the middle of the page. But this is kind of where we want to shop a little bit. These are excellent quality companies with some pretty good characteristics. Some of them are a tiny bit questionable. I don't think this one's going to hold up once people come to grips with the current frenzy. So that one probably drops down the list as more rational heads prevail. But um, the one that kind of jumped off the page for me, this goes back to our life after Google, was Alphabet. And Ken, I'm not hearing any dissension from you.
None at all, Mark. I think when you can get a company Google size with these numbers, and when you can say to yourself, on any reasonable analysis, this thing is probably a buy at the moment. I think it's time to pull the trigger on it. If I didn't already own as much Google as I owned, I'd be adding to my positions right now.
Absolutely. So, I mean, there are a few numbers on here that give me pause, and it's usually because of a disruption or some type of news related item. These numbers down here are fairly low. Um, Morningstar clearly disagrees or understands, or maybe a little bit of both when it comes to Lulu. And there's other companies on here where it's a little bit frisky. And how we use this type of a list is to just kind of you know do the where's Waldo type thing. Which one of these doesn't belong here? It doesn't look right. And which one of these or two of these looks pretty good all the way from left to right. One of those is Alphabet, and I'm going to add Gentex to the mix also, Ken, as two companies that we'll consider for today. Looks pretty good,
I'm
full left
I'm
to right.
very pleased with both of those, Mark. Very pleased.
Okay, so let's take a look at the two companies, and we will subject these to audience votes, and they are binding. Here's a look at Google using just the visual business model analysis at Manifest. You can see that the quality is basically topping out. You can see that the projected annual return, the return forecast was a little bit higher, but this is fairly close to a multi-year high situation. I would argue that it's pretty much up straight and parallel. And if you look at the slope of this line as something on the order of 15%, that's a pretty healthy growth rate for a company this size. We'll show on the next slide that the profit margins have been fairly steady. That leads to a nice blue line down here. So again, at 15% with this steady upper 20s profit margin and a PE ratio that if we can come to grips with it or warm up to it, uh, and we need some warming up these days, Ken. It's fairly easy to justify a return somewhere in that 10 to 15% range. So just
Yeah,
a
we're getting a comment from Lana in the audience that we should be aware that Google is laying off people. I'm not quite sure that that's the entire story. My research and some of my most recent readings indicate that while Google is getting some press for laying off certain groups of people in certain of their industries, they're also doing a lot of hiring in other industries. Google has a lot of different discrete companies within its umbrella, and they tend to work independently of each other. They have these things that, for want of a better term, are called moonshots, where you're not even really aware as a public
Right, right.
observer what they're doing. But Google is rather than layoff, I would say that Google is reshuffling its workforce, and it is laying off people with certain skills, and it's searching very aggressively for people with other skills to fill jobs in other parts of their business. I don't know what the sum total is. Google doesn't publish figures like that, but I'm getting the impression from listening to the chairman that the sum total is closer to zero than you might imagine when they talk about laying off people. So that's just kind of balancing the fact that there is a lot of press going to the numbers of people that are being laid off in some divisions. I'm not sure that that's the entire story. That's
Yeah,
all.
that's where context really does matter. I can remember Amazon and Microsoft and a few other companies coming under fire last year and 2 years ago for people that they were laying off, and they were doing exactly what Ken just described. First of all, the layoffs paled in comparison to in the past. So when you looked at what the real absolute numbers were and the net numbers, another story emerges. So it's good to put those numbers in context. Here's a look at the profitability of Google over time. This could be related to what Ken was just talking about. Maybe they're trying to fix this because that's a little bit of a downward trend, but uh, the analysts seem to think that they're going to be able to. So again, fairly consistent profitability. My scientific method of figuring out PEs is up at the top here. I close one eye and literally just pick a high and a low. A little bit more can go into that, but this is a good company. I mean, they've got some debt, but not an unmanageable amount of debt, and a very attractive interest rate. So when you start looking at it top to bottom, you see that it's a company that Morningstar likes. That's the low total return forecast. Excuse me, that's value line. Morningstar and the analyst consensus check in with their fair value estimates. So there's a lot to like here. It's not a slam both shoes on the table, strong buying opportunity, but it's pretty decent. Here's a look at that trend over time. This is what we were talking about. They're only back where they were 2 years ago. And a lot of people fail to recognize that. This is a fairly solid long-term trend. And then here's a quick look in the language of the stock selection guide at Better Investing. And I just threw some numbers at it just to see if it would be consistent. And there's just a couple little things that bother me here. I do think that this estimate right here is, we know that they're going to come in at 305 billion, so they're going to come in right on that dotted line. So I'm not too concerned about that. And Ken, you said that that's a fairly normal occurrence.
Well, again, I don't know if normal's the word I use. That's an old estimate as far as I'm concerned.
Okay.
Morningstar suggests that they're going to give us 2 years into the future, a 2-year sales estimate, and
Okay.
that's the next two dots that we see.
Mm-hmm.
That dot that you marked there is kind of carryover from the last time they provided data. And I'm just feeling that that's probably old. It might have come from 3 months ago, 6 months ago, 9 months ago, and it's not. It's more, I hate to say laziness on the part of the analyst community, but I don't think they bother about some of their older projections when they're putting new projections out a lot of times. What I will say is that we're getting some of our audience saying that don't forget that Google is already in the VUG that we just added to the portfolio.
Hmm.
But the whole purpose of that VUG is a holding tank, if I can label it in a different way. And we don't plan to keep that money in VUG for long periods of time. We plan to use that money as we move to 16 or so different stocks in this portfolio. That's just a place to put the money while we are deciding what we're going to spend it on.
Agreed.
And we think that VUG is probably giving us as good a return as any money market or any fixed income kind of a thing. And VUG is easily traded, whereas some of the more fixed income types of things aren't easily traded. They have to be held for certain lengths of time, and there's various rules attached to some of that fixed income stuff. So we're not going to keep that VUG around as we move through this portfolio. At least that's my understanding. Am I right, Mark?
That's correct.
Okay.
Time will tell. So anyhow, another thing that I would point out is I wouldn't attribute this necessarily to laziness, but at this time of year, we have this challenge at Manifest also. These numbers get jostled around quite a bit. And a lot of times they will just flop them around and it confuses the databases, if I can get really unscientific. And obviously, when you're basing calculations off of the slope of that trend line, it can cause issues. And I think that may be some of what you're seeing here. Just for informational purposes, these are the current numbers at Y charts. The sources of that data is very similar to what they have at Morningstar. So you can see the 2022s, these are 2022 actuals, along with the next 3 years of estimates. And what Ken is basically saying really does hold true. That green dot probably lines up with that one. This one probably belongs over here. This one probably belongs over here. That will probably get fixed fairly soon by whatever the source is of the data. But I do like digging into the actual numbers as these forecasts form. The one concern I would have is I looked at the sentiment uh, characteristics at Better Investing, and I was kind of surprised to see the numbers of 8% and 10% sales growth estimates when I think the company clearly merits, something on the order of 15-ish based on this picture alone. All right. So let's see what else we got here, Ken. I just threw the price PE ranges up there. You know that PEs cause me to have a headache, so I have to be careful. Just looking for a high and a low so I can have a reasonable average. I'm pretty sure that the average for Google ends up in the 21 or 22 range. So anytime you pick a high in the 30-ish range and a low in the high teens, you're going to be okay. I think I went with 30 and 18, so that's an average of 24. Certainly reasonable based on the history. So you can see we're talking about a company, again, not a slam the shoe on the table, screaming strong buy, but I'll take 11 to 16 from a company of this caliber on the
And of this
downside
size, Mark,
and the size.
because with the numbers as large as they are attached to Google, achieving percentages like this is a much more difficult task. If this were a $50 million company, I could say these numbers are a little bit anemic, but this is a billion dollar company, and it's achieving numbers that are quite formidable.
And they do a lot with data centers.
Yep. Yep.
Speaking of a recurring theme, so there we go. So with that, any other further discussion, or shall we move to a vote?
We're not getting a lot of questions. I'm looking in the question box. Cheryl wants to know: is there a reason that you substituted free cash flow for pre-tax profit on the graph?
Did I do that? Oh, I probably just wanted to take a look. I didn't realize that I
Yeah.
left that there.
Yeah, free cash flow is that purple line,
Oh,
and pre-tax profit's been turned off.
well, they're basically first cousins. So
Okay, okay,
we'll leave that as a discussion for another day. But I
all
personally
right.
don't care for free cash flow. I like the earlier version. The what is shown on the right there is the EBITDA margins. All right. So Ken, are you able to launch the poll, or do I need to do it?
Let me see.
See if we have you under lock and key.
Look at this.
You were able to do
Okay.
it. All right. So
Yeah, there we
again,
go. All right.
we're interested in everybody voting that's here. You are welcome to vote. If this were an Iowa caucus, we would be.
No, don't go there.
It was cold in Iowa.
Yeah, okay.
Are we able to vote,
No,
Ken?
you can't vote and I can't vote.
All right. So we already have 2 votes, sort
Yeah,
of.
we're up to 75% of our audience voting. I'm going to count backwards to 10. 85, 83% voting. So I'm going to close the poll. And Mark,
That's your typical 90%.
in the beginning right now, I'll tell you that it's unanimous. Nobody has any problems with us buying some Google for this
So
portfolio.
so we'll
We'll
all be
probably get
equally wrong
more.
together.
We'll
Together.
probably get more spirited discussion as we get more and more stocks into the portfolio. Okay.
All right. Well, let's go ahead and try to top it off. Since we're on a pretty good run, Gentex. The theory here, first of all, Gentex makes the mirrors and all kinds of stuff for virtually every car manufacturer out there. I don't know if they do anything for Tesla, but I promise I will look that up. This is a fascinating company, no stranger to our community. A number of you out there probably own shares of Gentex. I do in my personal holdings. I'm 99% sure that Ken does.
Absolutely, I do.
So part of the thesis here, at least for me, and Ken, step in if you want to, but this falls into the realm of people are going to continue buying cars. Some of them will be electric, others will be internal combustion, but cars will be purchased, and there's actually a fairly steady demand for cars going forward in the future. Now, these guys sell to almost everybody. They make parts and components for everybody. So this is an example of a company that wins no matter who actually sells the most cars. And I think it's a great investing concept to sink your teeth into and understand. You can see that this particular growth trajectory is somewhere around the 10 to 11% range. Their profits are also very steady, up straight and parallel for a company that's connected to an economically sensitive industry. 20% margins, 18 for a PE. Again, we're talking about returns in the mid teens. Not too bad for an extremely high quality company. You can see that that permeates everything that they do. They did have some pressures with the pandemic that they seem to have been making progress with. You can see the value line forecasts up here looking pretty strong. Different type of investment than the one we just talked about. We are now talking about PEs in the mid-teens to low 20s. But again, very consistent over time. What would you like to add, Ken?
Uh, the problems during 21, 22 were basically chip problems. They were constrained by, they use a lot of chips in the things they build. And so they were constrained by supply chains, by a shortage of the chips they needed to build the kinds of things they build. And that constrained the entire auto industry. I think most of you can remember half-finished cars sitting in huge parking lots waiting for chips so they could finish the car and get it sent out to the dealers. I think it's back on track. The one thing that I like about Gentex more than anything else is that it serves every single car manufacturer in the world. It serves the brand new manufacturers. It serves the older manufacturers. They all seem to have need for one or another of Gentex's products. So it's not going to have problems if some of the auto dealers don't do as well as others of the dealers.
And you know they also sell to Polaris and Fox Factory and those other companies that you like, Ken.
Yeah.
All
I'm
right.
going to take a side trip here. I have one person that says he voted no for the poll, and I'm going to suggest that I've been there before. These results are presented in whole numbers, and they are rounded, and one no vote would probably round to 0. So I'm going to suggest that's the reason for the no vote not registering. I don't have raw data, so I can't double check to make sure the poll is working correctly, but I do have experience with a poll showing 0 when there has been 1 or 2
Right.
people voting.
Yeah, and I'm not showing the second poll showing up, Ken, so we'll probably just have to do this one basically manually.
Okay.
Same situation. You get a buy zone, very decent characteristics with a mid-teen to upper teen type return forecast. So our motion here will be, because of the lower stock price, to purchase approximately 5 shares of Gentex. And I think we're going to have to vote by, I do not show the poll in my listing either, Ken.
So why
So
don't we do it this
let's do
way,
that with the
Mark?
question.
If you're going to vote negative, if you're going to vote positive, please do not put it in the question box, okay? If you're going to vote negative, then would you put that in the question box, and I can count the negative votes, and that way with a simple subtraction I can come up with the positive votes then. And I'm not getting any activity of any kind, Mark, in the questions box. I'll give people another 20 seconds. We did end up with 88% voting on that first poll, so I know how many people that corresponds to. I have 1 negative vote, and I'm going to close it down. So unanimous -1, Mark. Okay.
Okay, so we'll establish those positions and continue to work to build out the portfolio. Here's our reminder that we do archive all of these sessions on YouTube. You can look under Manifest Investing, and if you search for Roundtable or Bull Sessions, you will find these. If you have any trouble, let either Ken or I know. Our 3 getting started sessions are right there. I consider what we're doing here to be kind of an extrapolation of that, and let's have some fun. The roundtables are there, and the Bull Sessions are there.
We really would love for you to nominate some stocks. We can get the study ready to go if you nominate early enough for us to get it into the slides. But we'd love to add some holdings to this Buttonwood portfolio now that come right from our audience. So if you have a favorite stock you'd like to nominate to go into the portfolio, send the name to Mark and we'll get a study prepared. We'll put it up there and then we'll submit it for a vote to see if we can add it. We'll try to add 2 stocks, again in next week or in a couple weeks, Mark?
Yeah, one or two. We'll take it as they come.
Okay, that's great.
All right, so here's just a quick reminder that those of you that have wanted this for a long time, we actually do have a permanent link. You need to put the HTTP in front of this, or at least I do. Maybe I should do that right now, Ken. What do you think?
All right.
Yeah.
Just so everybody knows. So you need the HTTPS in front of it. And that will get you to a sign up page. You can sign up for any of the next 49 sessions for this year. Kind of don't see it that way, but this link will do that
And
for
that
you.
colon is correct, Mark?
Yes,
Okay.
Oh, do I need, let's try it.
Is it a colon or is it a slash?
Let's try it.
Yeah.
HTTPS : 2 slashes, isn't it?
Yeah.
and then a / bull sessions, and that should do it. So I need 2 / after this.
The colon. Yeah.
There we go.
Okay.
All right. Good stuff. Thanks, everybody.
Have a good afternoon, guys.
Anything else, Ken? Questions are all covered?
Where the questions are all covered, and we're in pretty good shape, Mark. Okay, we had a nice audience this afternoon. It's appreciated.
Yep. Thanks, everybody. Good hunting out there, and stay warm. And those of you in tropical climates, send some our way. Take
Good
care, everybody.
afternoon, everybody. Bye-bye.
Bye.